Good morning. Great. May I please ask if you turn off your cell phones or the sound on your electronic gadgets? That would be great. I'm Reena Aggarwal. I'm the McDonough Professor of Finance and Director of our Georgetown Center for Financial Markets and Policy. So I am delighted to welcome all of you here to Georgetown University and the McDonough School. We are again pleased to partner with the Financial Times with this event. The Center and the McDonough School, we regularly participate with the FT and partner with them in our events. So we are delighted to do that again. In this time of economic uncertainty and important regulatory changes, informed dialogue on global financial markets and the regulations that govern them proves increasingly important. Unfortunately, the financial sector executives have lost credibility, and policymakers are extremely busy keeping up with the new legislation and all the rulemaking. At the present time, there is a leadership void in the world of finance. So the Georgetown Center for Financial Markets and Policy is very well positioned to fill this leadership void. From our location here in Washington, D.C., I call it the new global financial hub, for good or for bad. The center strives to conduct relevant and rigorous research and provide thought leadership for global finance. Our objective is to help generate innovative solutions to challenging facing the global financial sector. Georgetown's reputation, location, and relationship with both government and industry make us well-positioned to facilitate thoughtful, open discussions among leading scholars, practitioners, and policymakers. As an example, we partner with the Milken Institute, and we do these congressional policy briefing series on Capitol Hill. Every month, we're on the Hill talking with senior staffers, and this event has become so popular, there's standing room only. We've covered many different topics, like financial market quality, like the fiscal cliff, and every month we are discussing something timely with the senior staffers on the Hill and helping them to understand the issues that they are going to be working on. So in a short period of time, the center has become the go-to place for financial leadership. I encourage you to visit our website and find out more about the center. At this time, I'd like to welcome and introduce David Thomas, Dean of the McDonough School of Business. Prior to his appointment at Georgetown, Dean Thomas was on the faculty at Harvard Business School, where he directed the school's organizational behavior unit and served as senior associate dean. Before joining Harvard in 1990, David was a professor at the Wharton School. Please welcome Dean David Thomas.
Thank you. It's a pleasure to be here this morning and to add my welcome to Reena's. Reena talked about the center. More broadly, I think that today's conference on financial market quality is emblematic of the unique position we at the McDonough School of Business feel that we can occupy. If you think about this conference on financial market quality, it addresses an issue that's paramount to the healthy evolution of our economy and our system. It also is emblematic of another truth, and that is that no single interest group represented here can solve this challenge. Not business leaders alone, not regulators operating in a vacuum, nor, and I hate to admit it, can the dazzling minds in academia address this issue simply from the ivory tower. What's required is conversation and collaboration amongst all of these stakeholders. And what we strive to do, and one of the things that attracted me, that I'm only in my second year as Dean of Georgetown, here is the possibility that we can become a place where people can come and have those conversations that might then stimulate and nurture the kind of collaboration that's needed to address these complex problems that sit at the intersection of business, government, and society. So in my view, the opportunity that we have here today is a seed that hopefully out of it will grow some ideas, perhaps some actions, most importantly, some relationships and collaborations that stretch across the interest groups that all have to engage these kinds of challenges that are facing us today. I'm also glad to see here today a number of students, and there'll be more who will be participating today, because the other aspect that's core to our mission is developing the next generation of leaders. And I think in opportunities like this, for them to sit at this intersection of regulators, business people, and academics, and to hear the conversations that need to take place around these challenges and opportunities is important for their growth and development, and to create a new kind of leader for business. So what you're doing here today, and I hope you enjoy it, but I want you to know that for us, it's a seed that we're trying to water and grow continually in our environment. So I know, having looked at the program, that this is going to be a stimulating day. I'd like for Maureen O'Hara will speak in a moment. I'd like for you to comment to her afterwards that she was really good, but you really loved the warm-up act that preceded her. Because she told me I was her front man, so I'm warming up the audience. Okay, but at any rate, I bid you a great day. Thank you.
Thank you, Dean Thomas. So today's timely discussion on financial markets quality, it brings together market participants, academic scholars, and policymakers to discuss what is and what is not working in our financial markets. Well-functioning financial markets are critical for the global economy and for the efficient allocation of resources. As this audience knows, it's not just Wall Street, but also Main Street that needs a well-functioning financial infrastructure. In the last few years, questions have been raised about the soundness of our financial markets. Are fewer IPOs taking place in the US because investors have lost confidence and exited? Or is the loss in confidence due to recent market glitches? Or is it due to market performance after the financial crisis? Or perhaps both? Technology has been extremely beneficial for the financial markets. Several academic studies have documented the recent improvements in market quality that have benefited investors. High-frequency trading has resulted in tighter bid-ask spreads, increased speeds of execution, and added liquidity to the markets. At the same time, the high speeds and interconnected automated systems can compound market disruptions that hurt investor confidence. The question is, how do we prevent such meltdowns, such breakdowns from occurring? Should we be concerned with liquidity disappearing quickly in both lit and dark markets, causing very large price swings? In terms of rules and regulations, are rules such as single stock circuit breakers, limit up, limit down, sufficient? Are they working? Do they need to be modified? Are additional rules and regulations needed? Our markets are extremely sophisticated, extremely complex, and for the most part, they're functioning smoothly. I hope our discussion today will be a constructive dialogue on how we can further strengthen our financial markets. I hope the discussion will be beneficial both for market participants and for policymakers. We are fortunate to have empirical evidence based on rigorous academic studies to guide our discussion today. We've gathered an excellent set of speakers to address the issues. We also have a very informed audience, and I expect many of them will contribute to the discussion today. So this is obviously a very timely topic with the SEC's Roundtable on Market Technology coming up soon. Capitol Hill is concerned about these issues. So a number of policymakers, regulators are concerned about the issues in terms of what is and what is not working in our financial markets. So I hope this conference will lay the groundwork for additional work that has happened in the past, will continue to happen in the future. So we're going to start the morning with our opening keynote address by Professor Maureen O'Hara, followed by a panel discussion on what is securities market quality and how should we think about it in this new era. I do want to take this opportunity to thank our sponsors, ITG, Gabelli Funds, T. Rowe Price, CME Group, NYSE Euronext, NASDAQ OMX, BATS, Virtu Financial, PwC, and Booz Allen. I also want to thank Dean David Thomas and the finance faculty here at the McDonough School for all of their help and support. So with that, let me introduce our opening keynote speaker, Professor Maureen O'Hara. It really gives me great pleasure to introduce a good friend as our keynote speaker this morning. Professor O'Hara is the Robert Purcell Professor of Finance at Cornell's Graduate School of Management. In a nutshell, Maureen is the scholar that started what we in academia call the area of market microstructure. Okay? She has done and continues to do path-breaking work in market microstructure, in addition to research in several other areas. She is the author of numerous journal articles, as well as the book Market Microstructure Theory. Professor O'Hara has served as president of the American Finance Association, Western Finance Association, Financial Management Association, Society for Financial Studies, and I could go on and on. She was formerly the executive director of one of the best journals in finance, the Review of Financial Studies. She serves as the chairman of the board of directors of one of the conference sponsors, ITG, and she serves on the board of New Star Financial, is a trustee of TIAA-CREF. She's a member of the CFTC-SEC Emerging Regulatory Issues Task Force, the Flash Crash Committee. Deans love people like Maureen because she's a wonderful example of somebody that impacts not only scholarship, academic scholarship, and students, but her work has guided policymakers and has been of tremendous use to market participants. So now I saved the most important part of the introduction for the last. Maureen and her husband, David, they are Hoya parents. Her daughter went to Georgetown, and please welcome Professor Maureen O'Hara.
Let's see if we can get this here.
Sorry.
We'll start at the end and work backwards.
Okay,
There we go. Well, thank you, Reena, and thank you, Dean Thomas, for a wonderful introduction and really a way to set us up for what I think will be a great day. I'm really delighted to be here, and I really thank Reena for asking me to come, and I particularly like getting to be the first speaker, because the first speaker gets to talk about all the things that we should do, and not be the one who actually has to figure them all out. So I'm going to spend a little bit of time really talking about the good news and the bad news. And I think that this conference is remarkable in terms of its timeliness, because as we think about these issues, market quality has really leapt to the fore. It's going to be one of those days, isn't it? Well, there's the old-fashioned way. There we go. Let me go back one. And it really is true. It's on everybody's agenda right now. If you look around, the Senate banking hearing committees are tomorrow, I believe. The SEC roundtable, I think, is scheduled at some point this fall. The MiFID II reviews are going on in Europe. I was just actually an author of some of the papers involved in the Foresight project, which they were busy trying to evaluate the HF issues over there. The Australian regulators are busy doing reviews. There are new rules that become implementable in Canada in October 15th. So this is a huge area, and I think rightly so. Because as we sort of look at what the issues are, there are really two that are fundamental to these issues. First, how are markets and traders doing in the new high-frequency era? And second, do we have the right market structure? And those are two extremely important topics. What I want to do is talk about market quality and what we may be missing. And in particular, what I'd like to do is really set out the fact that we actually do know a great deal about market quality from a variety of academic studies and also from studies in industry. And in fact, a lot of this is very good news. So we'll spend some time on the good news. We're going to spend a lot more time on the bad news. And I think the bad news is there's a lot that's disquieting about the markets. There's a lot that maybe we're looking at the wrong things. And I think as an academic, this is a particularly important subject for us because as academics, we use massive amounts of data to try and sort through and figure out how the markets are doing. And the challenge that I think we now face is that that might not actually be the right way for us to be answering these questions. So we're going to talk a little bit about that as we go along. And then what I'd like to do is briefly talk about some of the proposals that are being considered, because again, the European regulators in particular have come up with a raft of things that they'd like us to do or be done. And, you know, some of them may have merit and some of them I think are misguided. So I want to set out some of that. But let me be clear that I am the first of what will be many, many good speakers. And so I'm hoping that what I will do is really set the stage for the distinguished speakers who follow me to answer all these questions. So let me start off with the good news. Virtually every academic study that has looked at market quality in the high-frequency era has found that markets are now far better than they were. And you can look here at things like transactions cost, price efficiency, Reena mentioned liquidity. If you look at most of our academic studies, virtually all of them, the results are rather uniform that markets are better. And I run the risk when you're at a conference with many, many talented researchers that you put a few papers up and you recognize that you've now annoyed everybody whose paper isn't there. So let me just point out that, you know, it was just the page limits. So there's been a lot of nice work. And certainly, if you look at the academic literature, it's a little bit like the old, you know, Alfred E. Newman, what me worry, right? Things look great. And if you look at industry evidence, the same thing's true, that there's a variety of papers, and again, I've written down two of many, that suggest that when you measure, for example, transactions costs from the point of view of institutions, that similarly, things have greatly improved. Let me just show you two little pictures, because I like pictures. And This one is from Angel, Harris, and Spat, which is a very nice paper looking at trading costs in the recent period. And of course, Jim Angel, a faculty member here, so that's certainly a very influential paper. Again, you can see these were effective bid-ask spreads, and you can see just the dramatic drop both at NASDAQ and NYSE. Generally you'll find pictures like that in most academic studies where things clearly appear to be getting better among the metrics that we look at. Here's a picture that I think is also extremely important to think about, and that's the institutional picture. So this is data from ITG. My colleague Ian Domowitz sent this up to me, and it's basically from the transactions cost analysis that you do, and you can see this looks from first quarter of 2009 to first quarter of 2012. And these are essentially the institutional trading costs. These are the information shortfalls and the commission costs. And the trend is very clear, right? It is much less expensive to transact now in markets than it used to be. So under our old metrics, when we think about markets providing liquidity and price discovery, the evidence seems to be pretty good that markets really are very good. That's the end of the good news. Kind of short, but you get the general idea. I want to spend some time, though, on the bad news. And here is what I think makes these problems both important and intellectually interesting. So I think for once we have a situation where the academics, the industry, the regulators, and others, we all now face what, for a variety of reasons, is really a great area to be contemplating and thinking about. Let me talk about some of the bad news. Here's the first piece. Where is everyone, right? This is kind of a poetic interpretation of what the market looks like right now. It's also a picture from my last vacation. You don't usually get to do that. Market volumes are terrible, right? If you talk to anyone who's working in the market right now, there's a common theme, right? And that is, where did the market go? Right? If you look at the numbers, they're kind of scary. U.S. daily volumes are now 50% down from where they were in 2009, right? So the market levels just don't look like they used to. And I think there's a lot of concern about, quote, what the real volumes are, in the sense that TAB, for example, estimates that half of the volume is coming from high frequency. So if you think of the high frequency traders as not really being long-term investors, right? We're almost back to the old days where you had a dealer who was in between every trade. And we used to, as academics, used to say, well, when you were looking at the NASDAQ data, you really kind of had to divide by two because you had a buyer and a seller, there was always the dealer. So, we're kind of almost back to that era. So when you look at 6.4, you really have to recognize that maybe it's not exactly what 6.4 would have meant in the past. And then think about the fact that CSFB now estimates that ETFs are about 20% of market volume. So when you look at the market, the interesting question is, I think, the one I posed, where is everyone, right? And it's not just us. European share trading volume is at a 12-year low, at least as reflected in the FTSE. So the FTSE is now trading an average of 1.4 billion shares a day compared to 4 billion. I don't think it was 2000. I think it's more recent than that. But the point is that European share volumes are also moribund. FT is reporting last week that net selling among UBS clients is actually at a 3-year high. So we're seeing a market that, and the good news would suggest is wonderful, and the bad news suggests there's no one there. So there's a disconnect, and we need to think seriously about that. We know one reason, the great bond market migration, right? And again, these numbers are just remarkable when you look at how long this has been going on. I think all of us understood that in the aftermath of the crash, there was a bit of releveraging, there was a bit of perhaps movement away from risk, there was a sort of lack of confidence in the markets. But I think what has been particularly devastating for many firms, and I think for the market in general, has been the continuation of this, right? It doesn't end, right? They're not coming back, they keep going away. And I think that's a problem for regulators, market participants, and the economy, because to the extent that our equity markets are no longer viewed as where people want to be, it raises serious concerns about whether our equity markets can do some of the heavy lifting they have to do, such as providing new capital for firms coming out and providing liquidity and an asset that people can hold. So I think it's really a challenge, and it's where I want to start today, because it's easy for people to say, oh, the markets are great or this or that, but it's hard to quibble with the fact that nobody wants to apparently be there. So we're going to start from there. What's causing it? I think everybody has their favorite explanations. Certainly risk has been one that people and finance professors love, right? You know, but we have a problem there in the sense that, you know, markets do appear risky, and yet, you know, they've reached new levels of return that suggest that if people were concerned about the risk, and there's no question markets are risky, those who stayed in have been well compensated for it, right? So I think there's more to it than that. Everybody has an opinion about what's wrong. I think that Bill Gross's rather poetic view is one to think about. Right? I'm sure we all saw this. Like a once bright green aspen, turning to subtle shades of yellow, then red in the Colorado fall. Investors' impressions of stock for the long run, or any run, have mellowed as well. Right? I find it very restful to read that. Right? It makes me feel better. It doesn't solve the market problem, but I've come to an inner peace. And that may be that investors, you know, views for the long run have mellowed. And you know, who's to quibble? Bill's got all the money now because it all went into bond funds. But I don't think that helps us figure out how to unmellow their perspective. So let me suggest that maybe we're missing something, right? I particularly like this guy. I think sometimes, at least the journalists would lead us believe this is kind of how small investors feel now, that, you know, the markets, you know, we're supposed to be very different than they are, and maybe we are missing something, and I think that's a legitimate concern. I think one of the things we in academia believe is that the studies that we've done are useful, valuable, and in general, well done. I mean, we've used lots of data. We can tell you on average how the markets are doing. We can measure, you know, the efficiency on average. I mean, that's what large-scale empirical studies do. But maybe the real issue is episodic price behavior. And that's not something that academic studies have generally been particularly good at, because by definition, we draw the power of our studies from large amounts of data. Certainly the flash crash, Facebook, Night, all raise concerns about whether technology is out of control. And I'm going to leave that for later, we'll come back. But I actually want to raise a few specific price behaviors to illustrate what worries me. And in particular, I want to think about things that seem to be affecting the beliefs of traders, both retail and institutional. And I'm just going to pick on two particular things. I want to focus our attention on what happened on July 19th, earlier this summer. And I want to talk a little bit about games computers play. So July 19th may not mean much to a lot of people. I know May 6th, we all know what that was, and there are other dates. But actually, July 19th was remarkable. And let me just show you a few pictures. This is the behavior of Coca-Cola. Now, how can a stock the size of Coca-Cola be subject to that behavior, right? On July 19th, what we saw was there appeared to be some sort of computer algorithmic trading that was whipsawing these stocks. And this is Coca-Cola. It had company, right? This is McDonald's, all right? So you can see the same whipsawing behavior. It's happening you know, a periodicity, you can notice it goes up on the half hours, it goes down on the hours, goes up, goes down, I mean, this is not a high-quality market when you can have IBM and McDonald's or Coca-Cola. This is IBM. Same thing, same things going on. Is Apple. So for those in the markets, things like this are truly scary. You know, it is one thing to think about technology being able to cause aberrant behavior in a stock that doesn't trade very much, right? You don't even need technology to do that, right? You just need dedication, if you will. You can cause chaos. But to be able to do this to McDonald's, Coca-Cola, Apple, and IBM, to me, is scary. And it suggests that we have some issues here, right? We have issues with respect to how is it that algorithms of some sort, right? This is not an individual sitting there, right? These are computers that have somehow been playing games with markets to do this. We know that these sorts of games have been going on for a while. We live in a world now where you often have computer versus computer, all right? Let me show you an example. So this is actually some data that we had at ITG, and I wrote a paper called What is a Quote, and used this as an example, and I thought I'd bring it back today. What's going on here, all right? You can see the market's just opening. The little blue thing is actually the quote, the limit order that ITG is putting in, right? And the little green things are subsequent limit orders being put in to raise the quote, right? Now, what's really interesting about this picture is there isn't any trading here. There's no trading at all, right? ITG has put in a limit buy, right? And what's happening is there is a computer out there that keeps putting in limits above it to try and better the quote, right? And what's the game here? The game here is to try and sucker, you know, the original algo into essentially betting against it, raising its own price. And you can see it's working, right? And again, because you have algos that are basically programmed to take advantage of other algos. And you can see it happening, right? So, you know, the blue quotes keep going up. So, and there's no trades here, right? So this algo is suckering the other algo into competing against itself. Now, presumably, the name of the game is, at some point, the predatory algo decides basically to flip around, right, and sell and take their profits and run. In this particular case, there's a happy ending because ITG took their trade and went somewhere else, right? So they canceled the order, and then what do you see happening? You see the same trolling behavior of that computer algo, right? Again, games computers play, right? Now, every firm, whether it's, you know, all those firms up there have anti-gaming technology now. They're well aware that this is going on, right? So if you think about, you know, computer versus computer, then you also have versus computer, right? So it's not to say that this ultimately results in disadvantages to traders if the particular, you know, broker, venue, and whatever has these anti-gaming technologies. But, you know, again, this shouldn't be happening in a high-quality market. And you can clearly see that kind of behavior. Here's a second one. This is from Nanex. So this isn't my example. But, you know, what they're showing is what appears to be pack hunters forcing a stop loss. So, again, what you have is you have what appear to be a series of computer programs that are basically trying to run up and run down and run up and trigger those stop losses in the market for no good reason other than just to force the prices down and then to buy and make money. Now, these types of manipulation, which is what I think I would call it, I don't know if our regulators would call it that, but certainly this is aberrant and I think undesirable price behavior, really just points to the new world of how markets are working in these high-frequency, high-technology venues. And they definitely raise concern about whether or not we've got the right market structure and whether the markets are working the right way. So one way, obviously, to think about it today is, are the markets truly broken or just in need of adjustments? And I'll come back and I'll give my opinion on that at the end. But certainly, depending upon who you read or listen to, either it's hopeless and we should scrap it all, or maybe a few little tweaks might help. I'm not sure. I do think that there is actually an underlying question that has now risen to the fore, and this one I think is most unfortunate. And it's, are markets simply unfair? Now, given our setting today at Georgetown, I thought I would use this particular way to illustrate. I am sending you out like sheep among wolves. It certainly has a long history, and I think it raises a series of concerns. As academics, we don't generally work on unfair, because it's kind of hard to know what unfair is. But I think, again, as we think about the issues that we need to be working on, we need to be thinking about episodic versus averages. Maybe we do need to think about what causes people to participate. And certainly a lot of the literature in academia nowadays works on the fact that when there's uncertainty, the solution can be you just don't play. And that's a concern, because if unfairness leads to I don't want to play anymore, then it's consistent with sort of these declining market volumes that we're seeing. And it's a very, I think, scary question. And there are reasons to be concerned, right? Certainly, the co-location and advantages of HF traders have led some to wonder whether it makes sense for small traders to be in the market at all. And that's actually an old debate in some ways, right? But it certainly comes to the fore now. The SEC settlement with the NYSE has put the proprietary data feeds firmly in the spotlight and raises serious questions that I'm sure NYSE is dealing with, but so should the market, right? Everybody has proprietary data feeds, and the question of the advantages that they convey or don't convey are certainly important. The market linkages, I think, remains a huge issue. And there's an article in the Wall Street Journal today about the hide or slide orders, right? I mean, those orders have been around for a while. And it speaks to really the linkage question, right? You don't necessarily want to pay the access fees to send the orders. And I think it raises a lot of questions about how all things are linked. And then, of course, there's this potentially unproductive arms race and speed. Personally, I'm kind of not one of the, let's outlaw it because it's a waste of resources, because in fact, all those wasted resources are private expenditures for the most part, and if people want to make those expenditures, then, I think that's kind of up to them. But fairness is a kind of tough question, right? And I personally find that hard to deal with in trying to actually pin down what do we do. So let me suggest ways to think about what I think are not easier, but I think more cogent ways to pose these problems so that we can move forward to try and figure out solutions. Are markets transparent enough? I think that is a fundamental question that we need to think about, and in my view, no. Couple of issues that just come to the fore. The current tape, for example, doesn't have odd lots. There's lots of good reasons historically why they're not there. But nowadays, with algos routinely slicing and dicing orders into tiny little pieces, you're missing large amounts of the transactions in particular stocks. And it's particularly true now that we have a whole cohort of stocks who, for some reason, don't want to do a stock split. So when you have a or Apple yesterday hit $700 stock, almost all their trades are going to be odd lots now. And none of them are on the tape. So I think that's a very interesting problem, and I know it's one that actually the Consolidated Tape Organization is working on, and there may be changes. But it actually raises lots of other little problems, because if you do put everything on the tape, how can you even watch the tape? If every one share trade ends up on the tape, how do you know where the market is? This is something where I actually think academics can be helpful, because the reason you want to watch the tape is you want to get a feel for the market. And we're good at being able to talk about the sufficient statistics that you need to evaluate data. So maybe just looking at every single price isn't the right set of sufficient statistics. So I think that's a very interesting question that we need to think about, both from the point of view of industry and from the point of view of academics. Also, I refer to it, frequently as the national pretty good bid or offer, right? Because now that we have so many hidden orders, it isn't actually the best bid or offer. There's better prices out there, and you're not going to see them, and unless you happen to send your order in, you're not going to get it either. Which raises a lot of the questions that I think we need to think about. What information do we need in this high-frequency world? Let me raise another way to pose the question. Is there enough real liquidity? And I put this here because I think behind a lot of the MiFID II suggestions is a belief somehow that there's not real liquidity out there, that all the flickering quotes that come about because of order cancellations, right, mean that, who knows what the liquidity is. I think that's true, that there's an awful lot of order cancellations, but a lot of those are legitimate parts of trading strategies. The solutions that people have begun to put forward, things like minimum resting times, I think those are complicated, right? Because in principle, it seems like a good idea to say that, every order has to sit on the book at least, say, 500 milliseconds, right? Something that's still very, very tiny. And yet the challenge is that if you have a minimum resting time, then there will be orders that in high-frequency worlds now become stale. Those orders are more likely to be coming from the low-frequency guys, because the high-frequency guys can cancel so quickly, can move in and out. When they see that stale order, they're just going to move in and pick it off. So I'm not sure that actually is a good solution. I also think that these minimum resting times really inhibit intermarket arbitrage, which has really been one of the big features of the HF world. So I'm not sure whether it's the right idea or not, but I think as we begin to think through some of these, we have to recognize the costs and benefits as we begin to push on them. The order to execution ratios, I think that's another interesting area, right? Certainly free messages, if you don't have to pay for messages, why not use them, right? We all know from any economics course you ever took that if you don't have to pay any of the marginal costs, then you're going to overuse. But again, the question is, what's the right way to do it? It seems to me that that's probably something that is best left to exchanges, but I'm not sure. But just to give an example, the London Stock Exchange has an order-to-trade ratio of 500. And they put 500 because they believe that the clientele at the LSE needs to be able to send a lot of messages for every, for every order, every trade, because of the nature of the strategies. So if you're going to set a limit of 500, it's not really clear how binding that's going to be. Similarly, is there enough liquidity? Market maker obligations are something that's certainly been kicking around a lot. And in principle, again, I think there's a number of things that maybe recommend that. Certainly the new high-frequency market makers operate very differently than the old market makers did. And one of the challenges, again, is that market maker obligations have typically given the market maker some benefit for having to entail the costs of always being in the market. Now, a number of people have suggested that the benefit may be co-location, and therefore, if you co-locate, you should have obligations. I think that's an interesting question. For active stocks, I'm not sure that you need to have a market maker obligation, because even in the midst of the flash crash, there were still people, sending in and making markets. But for less active stocks, I think a very interesting question. And finally, you often have batch markets. People bring up the idea of bringing back call markets. I really believe that train has left the station, right? I think that I think call markets just, to me, are not the right solution. And you can even see it, for example, in even the dark pools, which originally started off, crossing networks used to have, crosses, periodic times during the day, and now pretty much everything is a continuous market, continuous crossing, because that's really what people want. So I'm not a big fan of that. Do we have the right structure for smaller IPO stocks? And here, I think my view is no. I do think that there are issues here. And again, who is providing liquidity for these stocks? I think that's a very interesting issue and one that I'm kind of working on myself. And certainly one of the issues put forward, a uniform tick size is really appropriate in this new day and age, right? We've always had uniform ticks in the US, but that's not true around the world. Around the world, tick sizes usually change with the price of the stock. But perhaps a better structure would be to have tick sizes that change with the activity in the stock. Now again, why do you want to do that? It's because the tick size itself, the minimum tick, is important because it influences the willingness to put in a limit order. And that limit order or liquidity provision issue comes back, I think, when we look at the smaller stocks. So those are just a few of the questions that I think we really need to think about, as well as, is technology under control? It's a really interesting challenge. We certainly have had some rather vivid and bad examples of technology not under control. It's often easy to forget that, we've often had situations like that. Years ago, I know, I used to go up to the NASDAQ Economic Research Office, and they had that stuffed squirrel that they had up there, and apparently that little critter took down the entire NASDAQ market at one point because he got involved. I mean, we've always had technology questions. I think the challenge today is that when the technology fails, it seems to be much more important. And I see the issues, and I do think there are things we need to think about. Again, the Europeans were really big on algorithmic notification. I think that is, it's a nice idea. I think it won't do much. And the reality is that the large traders have thousands of algos, and they change them all the time. And sometimes it isn't just one algo, it's the interaction of the algos. And how you could ever test that would be, beyond what I see as feasible. But, I just raised that to talk about, not that you couldn't require it, it's just that how would you make it effective? Circuit breakers, I'm actually a big fan of. I think limit up and limit down are a good idea. I think what they do is they limit uncertainty, right? If something really horrible happens just about when your order hits, there's a limit to how bad it can hurt. And one of the things we do know is that uncertainty leads to lack of participation. So to me, the limit up, limit down are a mechanism for trying to deal with the uncertainty. I think actually the exchange matching engines present a new and probably very productive way to think about dealing with some of the new world that we're dealing with. The challenge now in a high-frequency world is that even in very active stocks, you can have books empty in seconds, in milliseconds, right? Liquidity is not a given. So consequently, what you can have 20,000 buy orders arrive followed by 20,000 sell orders, right? I mean, it's unlikely, but it can happen. So we need to think about how it is that as those orders come in, the exchanges are matching them, and looking at order toxicity or the imbalances may be helpful. Now, one of the most important things of the kickoff speaker is to stay somewhat on time, right? So that would be me. So let me just conclude and talk about the path forward. There's no shortage of questions, but maybe answers not so much. I think, though, that there's a lot of productive debate going on. And I think there's a lot of debate both from the side of the academy, where many of us are working on these problems, from the side of industry, who's, I think, being very innovative, trying to come up with solutions. And I think there has to be from the side of the regulators, who I think are well aware of these challenges and are trying to sort it through. And that's obviously the first step. I think we need not lose sight of the fact that market evolution always leads market structure, right? It just, by the nature of how the economy works. But I do continue to believe that if we build it right, they will come. And the market, hopefully, will have a few more creatures in it. Thank you very much.
Maureen, we'll take a few quick questions.
Look at my wildebeest. I think they're stunned. Stunned. Terry.
Terry, you want to come up to the mic, please?
When you see a lot of this, what you term as aberrant behavior, how do we disentangle this from negotiation, from what we think of as basically this is a negotiation between a buyer and seller in an electronic world, or this is really how an auction works, as opposed to having some more nefarious intention?
I think you raise a really good point, right? How do you recognize when things are askew? I'll tell you that I think the examples I put up are hard to come up with any kind of legitimate negotiation between a buyer and seller unless you're actually planning on taking over Coca-Cola to cause that kind of price behavior, right? I mean, that to me is someone playing games with an algo that shouldn't be doing it. But I agree with you. The challenge for FINRA and for the exchanges and others is, how do you find the aberrant behavior, right? The only thing I can say is that, the big data has transformed trading, right? And it's kind of interesting now when you think about the fact that, Watson, who showed such, talent at playing Jeopardy, now has a new job, right? Watson's working for some of the hedge funds. And Watson is trying to read everything he can and figure out what to buy and sell, right? So I think there's a lot of technology now that can be brought to bear. And my suspicion is that, looking at that behavior leads one to believe that, there's something not quite right. And agreed, on the quote dangling and the various other things, I can't come up with a legitimate explanation for that, but maybe others can. But you raise a good point, Terry. All right. Thank you.